Welcome back to the deep dive. Today we're getting into the mind of, well, a giant, Warren Buffett. But not just his success, we're looking at the pivotal moment. The mental shift, he says, changed everything for him. It's about moving away from something most of us do, trying to predict stocks, to something fundamentally different.
Exactly. It's not about some secret formula or, being lucky. It's about a core change in perspective.
Yeah.
He calls it rejiggering his mind. And that shift is really the key to understanding his long-term success.
So if you, listening right now, ever feel stressed by the market going up and down, or feel like you have to know what's next, this deep dive is probably for you. To really get the impact of this change, we kind of have to go back, way back, to his very first investment. Sets the scene, doesn't it?
It really does. He was just 11 years old.
11. And he wasn't just dabbling. He put in every penny he had saved up, which was, what, $14.75?
That's right, $14.75.
Mhm.
And he bought 3 shares of a company called City Service. But crucially, it was preferred stock.
Okay, preferred stock. Why is that detail important? What does that tell us about the 11-year-old Buffett's mindset?
Well, preferred stock often acts a bit more like a bond. It usually pays a fixed dividend. Its price tends to move less dramatically than common stock. People often bought it hoping for a quick, relatively safe gain, maybe a small price bump, or just collecting the dividend. It wasn't really about betting on the company's long-term growth or, its underlying business success. It signals he was thinking about the stock itself, the piece of paper, not the business.
So even from the start, the focus was on the stock's behavior, not the company's health.
Precisely. He had the intelligence, clearly, and the initiative. But the framework, the way he was thinking about investing, it was fundamentally pointed in the wrong direction, as he later realized.
And this is the core idea we're unpacking today, right? That the big lesson isn't about timing or genius stock picks in the usual sense.
No, it's about understanding what you actually own. It's about value, incredible patience, and thinking like a true owner, not just a trader. We're looking at that intellectual light bulb moment.
Okay, let's dive into that initial flawed framework then, because honestly, it sounds a lot like how many people approach the market today. What did investing mean to Buffett for those first, say, 8 years after that City Service purchase?
Pure speculation, almost entirely. He saw it as picking stocks, watching them bob up and down.
So he'd buy something, and his main interest was, did it go up today? Did it go down?
Yes. He admits he wasn't really digging into the business operations, the management, the competitive landscape, none of that. He was hooked on the ticker tape action.
And the core belief driving this was
That the most important thing, the absolute key, was to predict. Predict what an individual stock would do next. Predict what the whole market would do next. That was the game he thought he was playing.
which naturally led him down the path of trying to find tools for prediction, technical analysis.
Exactly. And he wasn't casual about it. We're talking intense study. He describes reading hundreds, literally hundreds of pages on the topic. Books like Edwards and McGee, the sort of Bible of technical analysis, and others like Garfield R.W. He read them over and over.
For listeners who aren't familiar, what's the essence of technical analysis? What was he trying to do by reading those books?
It's basically chart reading. You study historical price movements, volume patterns, things like moving averages, support levels, resistance levels, all plotted on charts. The underlying idea is that all the important information is already baked into the price, and that past patterns can help predict future, usually short-term, price movements.
So you're looking for shapes on a graph. Head and shoulders, flags, pennants.
That's a big part of it, yeah. Edwards and McGee is famous for cataloging those patterns.
Yeah.
And it feels empowering, right? Like you're decoding secret signals the market is sending. You just study hard enough, spot the right pattern. You can outsmart everyone else.
So incredible effort, real dedication, but pointed entirely at the wrong target. He was analyzing the stock's shadow, not the business casting it.
That's a perfect way to put it. He was operating on the wrong premise entirely. Thinking of stocks as just blips on a screen, lines on a chart, things to be analyzed for their next wiggle. He spent 8 years doing this. 8 formative years trying to forecast volatility, trying to guess the market's mood swings. He now calls it a complete waste of intellectual energy, trying to win a game based on predicting mass psychology instead of analyzing business fundamentals.
Okay, so this sets the stage for the big shift, the rejiggering. It wasn't a market crash that changed him, was it? It was reading something.
That's right. The turning point came when he was about 19, maybe 20. He picked up a copy of the 1949 edition of The Intelligent Investor by Benjamin Graham.
Ben Graham, his future mentor and boss.
The very same. And Buffett has consistently called that book the most important book on investing ever written. For him, it changed everything.
What was the immediate impact of reading it?
His own words. He realized he had been doing everything exactly the wrong way. Just imagine that realization after 8 years of intense effort in the other direction.
Wow. So Graham flipped the switch. What was the core message that hit him so hard?
Graham taught him that a stock isn't just a ticker symbol or a line on a chart. It's an ownership stake in an actual business. A fractional ownership, yes, but ownership nonetheless.
That's the fundamental shift. From stock buyer to business owner. How did that change his practical approach?
Radically. He says from that point forward, he never bought another stock in the old sense. He bought businesses that just happened to be available for purchase piece by piece on a public market. It completely reframes everything. You're not buying a lottery ticket you hope goes up. You're putting a share of the profits, the assets, the future earnings potential of a real operating enterprise, a farm, a factory, a brand.
And you start thinking like you own the whole thing, even if you just have a few shares.
That's the mental discipline you ask. Is this a good business? Do I understand how it makes money? Would I be happy to own this whole company forever if the stock market closed tomorrow?
Which leads to this incredible side effect,
Yeah.
the release from anxiety about market fluctuations.
Totally. If you genuinely see yourself as part owner of, say, Coca-Cola, the business, why would you panic if the stock price dips 5% on some random Tuesday? Does Coke sell less soda that day? Probably not. Buffett is very open about this. He says he has absolutely no idea what the stock market will do next month or next year. And crucially, he doesn't care. Whether the stock price goes up or down short term is irrelevant if the underlying business is performing well and increasing its intrinsic value.
He talks about Ben Graham's concept of Mr. Market, right?
Yeah, it's a brilliant allegory. Graham pictures the market as this manic-depressive business partner. Every day, Mr. Market shows up at your door and names a price at which he'll either buy your share of the business or sell you his. Some days, he's wildly optimistic and quotes a ridiculously high price. Other days, he's terrified and offers to sell you his share for peanuts. The point is, he's there to serve you, not to guide you. You're free to ignore him completely unless his price is compellingly attractive, either to sell if it's crazy high or usually to buy if it's crazy low.
So you interact with the market only when it offers you a clear advantage based on your own assessment of the business's true worth.
Exactly. You don't let Mr. Market's moods dictate your own feelings or actions about the business you co-own.
This connects to another really interesting point he makes about intelligence. You'd assume you need to be a genius to get Buffett-level results.
But he argues almost the opposite. He says you don't need extraordinary brain power. He's famously said having a 170 IQ is no advantage over a 120 IQ in investing. He even suggests it might be a disadvantage.
Why? Why would being smarter, in the conventional sense, potentially hurt you as an investor following this philosophy?
Because the core principles Graham taught are actually quite simple. Not easy, but simple. Buy good businesses when they are cheap, hold them for a long time, understand what you own. Someone with a super high IQ might find that too boring, too simple. They might feel compelled to find complex strategies, use leverage, trade frequently, make intricate macroeconomic forecasts just to feel like they're using their big brain.
They overcomplicate it.
Precisely. Whereas someone with a solid but perhaps less stratospheric IQ might be more temperamentally suited to just follow the simple proven rules with discipline and patience. The market rewards temperament and discipline far more than raw intellect in the long run.
So it's not about raw processing power. It's about having the right orientation, the right mindset.
That's the word he uses, orientation. He estimates something like 90% of people buying stocks lack the right orientation. They're still thinking short term. What stock do I hope goes up next week? That's speculation, not investing in businesses.
Buffett's playing a completely different game.
A much longer, calmer game, using the market as an occasional servant, not a daily master.
This leads us perfectly into the next crucial element, patience, and his reaction to market downturns. Most people feel sick when their portfolio drops.
They see red on the screen and they panic. They want to sell, stop the bleeding.
But Buffett,
He genuinely feels better. It sounds counterintuitive, even jarring, until you fully internalize that ownership mindset we've been discussing.
explain that. Why does he feel better when prices are falling?
Because if he's identified a great business that he wants to own more of for the long term, a lower price means he can buy more shares, more ownership, more future earning power with the same amount of capital.
The business itself hasn't suddenly become worse just because Mr. Market is having a panic attack.
Exactly. Its intrinsic value, its ability to generate cash next year and the year after, is likely unchanged or only slightly impacted temporarily. But the price tag Mr. Market is offering is suddenly much lower. It's like your favorite store having a massive sale on something you wanted to buy anyway.
He uses the farmland analogy to make this crystal clear, doesn't he?
Yes, it's maybe his most famous and effective analogy. He says, imagine you own a farm. You bought it because you understand farming. You like the soil quality, the potential crop yield, the location.
You care about the farm's output.
Right. Now imagine your neighbor, who knows nothing about farming, comes over one day in a panic because he heard some rumor, and offers to buy your farm for 30% less than you think it's worth. Do you immediately sell?
Of course not. You'd think he's crazy.
Exactly. In fact, if you had some extra cash saved up and you liked your farm, you'd probably be thrilled if other farmland prices nearby dropped because you could buy more acreage cheaper.
The logic for owning stocks viewed as businesses is identical.
Identical. A stock price decline for a fundamentally sound business you want to own long-term is an opportunity, not a disaster. It's a chance to increase your ownership stake at a discount.
This completely flips the emotional script on market volatility.
It does. Fear gets replaced by potential greed. Not speculative greed, but the rational desire to acquire more of a productive asset cheaply. This breeds enormous conviction. It lets him keep his focus on the long game he knows he can win.
And he lives this conviction. You mentioned how much he typically keeps invested, right?
Yeah, he's consistently said he's never had less than 80% of his net worth invested in American businesses viewed as businesses. Not as stocks, but as slices of productive enterprises.
Because he knows he'll win over time. How can he be so sure?
Because he believes the game is fundamentally very, very, very easy if you have the right lessons, meaning Graham's lessons about buying value, understanding the business, and ignoring Mr. Market's noise. The long-term trajectory of good businesses is upwards.
Okay, but let's push back a bit for the listener at home. It's easy for Buffett, a billionaire, to say, ignore the dips. What about someone whose retirement savings just dropped 40%? The fear is real. How do you manage that emotion, even if you intellectually get the farmland analogy?
That's the million-dollar question, maybe billion-dollar question. The emotional discipline is the hardest part. This is where his private market test comes in. It's a mental exercise.
How does that work? What's the test?
He asks you to imagine there is no stock market. None. If you wanted to invest your savings, you'd have to buy businesses privately. Maybe a local laundromat, an apartment building, a share in a friend's company, or, yes, a farm.
Okay, so no daily quotes, no ticker tape.
Right. How would you make your decisions then? You'd have to focus entirely on the business itself. What are its earnings? Are they sustainable? What are the assets worth? Who's running it? Is the price you're paying fair compared to the cash it generates?
You'd focus on the fundamentals because there's nothing else to focus on.
Exactly. You'd save your money carefully, wait for a good opportunity where the price makes sense based on the underlying economics, and you'd invest expecting to get your return from the business's operations over years, not from selling it to someone else next week for a quick profit.
You'd be forced into long-term thinking.
Completely. You'd focus on the quality of the asset and the cash flow it produces.
Yeah.
You wouldn't be distracted by the daily noise and emotional swings of a public market. Buffett argues people would actually be much better investors if the stock market didn't exist to constantly tempt them into irrational short-term actions.
The market itself becomes the distraction from the real task of finding and owning good businesses.
That's the core insight.
Yeah.
And this mindset also prepares you for the reality that truly great investment opportunities, those fat pitches he talks about, are rare.
How rare?
He suggests maybe they only come along once every decade or two. Think major crashes, sector meltdowns, times of extreme pessimism when Mr. Market is practically giving away great businesses.
So the game isn't about constant action, it's about constant preparation and patience.
Precisely. You do the research, you understand the businesses you like, you know what price would be a bargain, and then you wait.
Right.
You have the conviction and the cash ready for when those rare moments of extreme opportunity arise. You don't need to swing at every pitch.
So we've got the internal shift owner, not speculator, and the disciplined patience, ignore noise, use the private market test. But all of this rests on one massive underlying assumption, doesn't it?
It absolutely does.
Yeah.
A foundational belief that underpins everything else.
Which is
The long-term success and prosperity of American business, and really the American economic system as a whole. His patient buy-and-hold strategy only works if the overall economic pie is constantly growing over time.
He's betting on the horse race, not just the individual horse.
You could say that. He's betting on the dynamism, the innovation, the rule of law, the sheer productivity that has historically characterized the U.S. economy. He often talks about the tailwind of American growth. Betting against that consistently has been a losing proposition for centuries.
And he backs this up with data, not just faith, right? Looking at long-term wealth trends.
Oh, definitely. He points to the fact that despite cycles and crises, a greater percentage of the U.S. population today has more real income than ever before. Look at bank deposits, asset accumulation.
Yeah.
The overall wealth is staggering compared to previous generations. He also makes the point about things like mortgages, many people locked in historically low rates, which means their housing costs are fixed while incomes generally rise over time. It points to a system that, for all its flaws, continues to generate widespread prosperity over the long haul.
The comparison he makes to Rockefeller is just mind-blowing, though. That really frames the scale of progress.
It's astonishing when you really think about it. John D. Rockefeller, the wealthiest man on earth when Buffett was a kid, arguably lived a life with fewer comforts and securities than even lower-income Americans today.
How so? He could buy anything, surely.
He could buy anything that existed. But think about what didn't exist or was primitive. Medicine is the starkest example. Buffett points out dentists didn't use Novocaine when he was born. Rockefeller, for all his billions, couldn't buy antibiotics, modern surgical procedures, or effective treatments for many common ailments that we take for granted. Think about travel. He had private rail cars, sure, but no quick, safe air travel. Entertainment. No instant global news. No high-definition sports replays. No vast digital libraries of music and film. Communication. Telegraph and early telephones, not smartphones.
So the baseline quality of life, the access to innovation and comfort, has just leaped exponentially for almost everyone.
Massively, even for people struggling today. Many aspects of their health, safety, and access to information would be unimaginable luxuries to the richest person a century ago. That's the power of systemic economic compounding.
It drives home that the real miracle isn't picking the right stock, it's being invested in the system that produces these miracles consistently.
That's exactly his point. He frames the American economic story itself as the miracle. Think about it. The U.S. started with maybe 0.5% of the world's population.
Tiny fraction.
These people weren't inherently smarter or harder working than anyone else on Earth. But you fast forward, what, 3 lifetimes? And that tiny group commands over 20% of the world's entire economic output, its bounty.
How did that happen?
A unique combination of factors: rule of law, property rights, free markets, innovation, a culture of enterprise. Whatever the exact mix, he says, it has worked like nothing else in history. That's the powerful tide investors get to ride.
And this historical perspective provides the confidence to ignore the short-term predictions and noise.
Completely. He uses another great thought experiment. Imagine going back to the Constitutional Convention in 1789. Try explaining modern life to those delegates. Airplanes, smartphones, satellites, mRNA vaccines.
They'd think you were absolutely insane, a lunatic.
Without question.
Yeah.
Their framework couldn't possibly conceive of it. So if the smartest people of that era couldn't predict the changes over the next 3 lifetimes, why do we think we can accurately predict market movements over the next 3 months?
It's a profound check on our forecasting hubris.
It really is. The focus should be on participating in the long-term value creation, which has been immense, rather than trying to time the unpredictable short-term fluctuations. He talks about the value of an hour of human labor today buys unbelievably more in terms of quality of life than it did 100 years ago. That's the engine you're investing in.
Okay, let's try and pull these threads together for the listener. The journey starts with an 11-year-old Buffett buying preferred stock, thinking the game is about predicting prices.
Using complex charts and intense effort, but fundamentally misoriented.
Then comes the Ben Graham revelation. Stop trading stocks. Start owning businesses.
That's the first core shift. See yourself as a long-term owner. Focus on the business's value and cash flow, not the stock's daily price wiggles. Use Mr. Market, don't be used by him.
And the second core shift, or maybe the foundation for the first.
Marry that ownership mindset with a deep, historically grounded faith in the long-term compounding power of the overall economic system, particularly the American system he knows best. Bet on the rising tide.
And the result is a transformation from anxious, effortful prediction to calm, patient ownership. It's less about being smarter, more about being properly oriented and disciplined.
Exactly. It replaces the stress of needing to outguess the market every day with the, frankly, much simpler task of identifying good businesses, buying them when the price is right, and then letting the power of compounding do the heavy lifting over years and decades.
A truly fundamental shift in thinking with profound implications. This has been incredibly insightful, really getting to the core of that mindset.
It's my pleasure. It really is the bedrock of his philosophy. And maybe a final thought for everyone listening, something to chew on directly from this way of thinking.
Go for it.
Ask yourself this. If the stock market announced it was closing down completely for the next 5 years, starting tomorrow, how would you feel about the investments you currently own? Would you still feel comfortable owning those specific businesses, knowing you couldn't sell them, but you'd just collect the dividends and rely on their underlying operational success? The investments you'd feel perfectly fine holding through that 5-year closure. Those are likely the ones where you're truly thinking like a business owner, the ones that make you nervous. Maybe you're still acting a bit like a stock speculator with those. It's a good gut check. I'd encourage you, the listener, identify maybe just one holding where you feel more like a speculator and try to consciously shift your thinking towards being an owner.
That's a powerful exercise. Great final thought. Thanks for tuning in to The Deep Dive. If you learned something new today about shifting your own mindset, please do subscribe, rate us, and share this deep dive with someone who might benefit. Remember, building wealth often feels slow, but it's the strategy, not the speed, that wins in the long run. We'll see you next time.